How valid is the efficient market hypothesis? And is energy transfer a quality dividend play?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our June 11th, 2024 edition of InvestTalk. I am Justin Klein, and I want to thank everybody who showed up for our wealth webinar that took place just a few hours ago. And we really unpacked and did a deep dive into the factors that matter when you're trying to find good opportunities in the markets. It's not just about chasing the dividends. That's why we call it digging deeper than dividends. So many people simply look at that and they don't look at the other factors. So we look at what quantitative factors, meaning the numbers to consider, as well as the qualitative factors to make sure that whatever advantage a company might have, that it continues that advantage over the longer term. So I hope everyone who attended joined. We should have the replay up soon. I don't have a date on that, but should be within the next week or so. Be on the lookout for that. But we did get to a nice Q&A session. So thanks for everyone that showed up to that webinar and asked your questions. That was a great one. Now, on to the business of this show. That was the hour just a few hours ago, but this is this hour, and we want to focus on making the most of this hour with you. And we do that by giving you data and actionable material for you to take back to your personal situation and make better decisions. Not just one time, but consistently, day after day, week after week, month after month, and year after year. Now, in just a bit, I'm going to talk about the market performance as we head into Fed Day tomorrow. This is Fed Day Eve. And we'll run down the show topics as well. But first, let's tackle this caller question now.
Hi, this is Gino from San Jose, California. I just wanted to look at a stock here of DDS. The symbol is the DDS is Dillard, the retailer. I wanted to see, what do you think about that one at this moment in time? Trying to see if I could purchase that one, but let me know about what you think about that. Thank you very much, and have a great day, and talk to you soon. Bye-bye.
All right, this is Dillard's, and this one did very, very well during the pandemic, or post-pandemic, shall we say. They earned $3.66 in 2020, but then they earned $40 per share in 2022, and then $48 in 23, and then $42 in fiscal year 2024, and then going forward, expected to earn $34 and $29 per share. So there's certainly a reversion to the mean going on here. But even if it can level out around $30 per share, that is a magnificent jump from the $3.66 it earned in 2020 and $6.13 it earned in 2019. But the big question is it going to head back to single-digit earnings or level out around $30 on a $418 stock? If it levels out around $30, that's fantastic. Once again, if it heads back to single digits, it's grossly overvalued. So it really depends on your view of the department store. They certainly have a clean balance sheet now. They pay a little bit of a dividend, but their return on equity is 40%, return on invested capital 31%. If you attended the webinar today, you'll know how important those numbers are. Historically, though, it's not nearly as profitable. So what I would be doing is, we haven't dug deep in this name, but you want to dig in. What is causing this explosion in profitability? Because there has to be a source of this. You can't just have a pandemic and suddenly they make a bunch of money and then that's sticky. There needs to be something different about their business for this to sustain this level of earnings. Now, what I will say on the technical front, it has been weakening as of late. It peaked back in early April at $475 per share. Now we're at $418, and it looks like it's headed lower. So I would do a deeper dive, and I would wait for the technicals to improve, because right now they just aren't lining up for me. So I'm passing on it, but while I wait, I'm doing a deeper dive to see where earnings are likely to level out at. Okay. Now, we have a lot of ground to cover over the next 45 minutes or so, and our main focus point is about the efficient market hypothesis. This is coming from Eugene Fama. He's the father of modern finance, and there's a hypothesis that says all relevant information is already factored into stock prices. And a lot of people talk about this, but what they don't talk about is that it is a hypothesis. That's what it is. It's a hypothesis. So we're going to dig in to this hypothesis, and I'll give you my take on how much of it I think actually is relevant to the actual market and your investing and market movements. Okay. We also have other topics on the docket. One is in regards to how to pick winning stocks. A lot of people look for those cheap laggards, and more often than not, they don't turn around. More often than not. Now, certainly, if you pick the ones that do, you can earn big returns. We certainly found plenty during the COVID downturn. But that's few and far between, especially in most markets. Okay, if you're looking at a stock today where the indexes are near all-time highs, but it's near all-time lows or 52-week lows, what are the odds you're going to pick the one that's closer to a 52-week low and win out versus ones that maybe are closer to their 52-week highs? So we're going to talk about those numbers. Also, there's a new report from the IEA. There we go. IEA. And this is the International Energy Agency. And they had a report on clean energy. And so we're going to look at renewables, fossil fuel usage, and just what this report is telling us about the global energy markets. And then lastly, we know that the office market is distressed. But there are ways out in certain markets, certain buildings, and there is a city north of the border in Canada that is seeing a lot of progress in being able to turn some of their downtown offices into residences. So we're going to look at that story as well. And of course, your voice bank questions are number one. And that means we're going to answer a question on 401k rollovers, as well as Ally Financial, ALLY, and of course, comments submitted via our YouTube channel. Now, of course, we welcome your finance and investment questions right now at 888-99-CHART. We're heading into a short break, and on the other side, I'll talk about today's market activity and take your questions on the InvestTalk Anytime listener line at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART. Go talk to Jeff in Alabama, and he's looking at CX, and this is a Mexican cement producer. Do you own it or looking to buy it?
I'm thinking about initiating a small position at this time.
Okay. And what's your reasoning?
Well, I'm pretty familiar with the company. They have a lot of presence in Alabama. Actually, they've got a lot of concrete facilities, ready-mix facilities, and I work with Department of Transportation, and I just see a lot of the infrastructure that's going on.
Okay. So you think they're in high demand. Now, do you think they're turning that demand into profits?
Right now, the the interest rates is probably having a little bit of impact on the home side of it, but I don't know. The government's spending money on transportation.
That's
They're doing
true.
a lot of that.
That's true. But your issue here, and this is something that a lot of investors have trouble with, is they see demand for a product or a service, and they think that's the good company to buy. But the reality is you have to turn that what they're focusing on is on top line, right? Revenue. When you're investing in an individual company, you want to be focusing on profits, right? Who cares if a company is selling their product or their service more and more? If they're not turning that into profit, then that doesn't go to you, the shareholder. And that's my issue here. And it's pretty simple. Cemex is in the material space. It makes concrete. Most companies, most entities really don't care where their concrete comes from. And therefore, margins in this business are very small. And thus, profits are very small. The return on equity for Cemex right now is 1.73%. Its average over the last 5 years is 1%. Its median is 2.7%. It hasn't had big profitability since 2008. And that's why the stock has gone nowhere. Okay? This fell in 2008 with the rest of the market. It was at a high of $28 per share. Fell to a low in 2008 around $2 and a little less than $3, let's call it. And it's been chopping in a range between $12 and $2 ever since. And now it's at $6.45. And that's because its return on equity, its profitability metrics, return on invested capital only 1.5%. All of those are very low. Now, it doesn't have a lot of, does no long-term debt. That's good. But those sales, which earnings are expected to rise this year, near an all-time high, and that's a positive. But it's not really translating into great profitability. And then you look at the relative strength, it's bad. This is at the lowest level since November. While the market's at new highs, its relative strength is 20. So nothing's lining up here. You might what you are going off is what is called an anecdote. But a company like Cemex, they're pretty large, $28 billion market cap. So it's not a small company. It has large revenues. Last quarter did $4.1 billion in revenues. So you're talking about a company that does about $17 billion annually in revenues. So as you would imagine, with that size of revenue, they are all over the place, all over the world, especially in North America. And you can have good demand in one place and not so good demand in others. So this is a good example of how you have to take your real world anecdote, which that's usually what most people are seeing in their day-to-day lives. And then you have to confirm that with the numbers, with the profitability metrics. And then you have to go to the chart as well and say, is that also confirming those other two data points? And the reality here is it's not lining up. So while I like your starting place to a degree, it just doesn't check the other boxes. Thanks for the call. Now we're heading into a short break. Still to come, answers to caller questions, a market wrap, and I'll get into today's focus point. This is InvestTalk. Give me a call at 888-99-CHART. You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Did you enjoy our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts and get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join the community of informed investors.
Now let's take a look at the market today. It was a mixed bag overall. Large caps did the best, mainly on the back of Apple being upgraded. That was up about 7.25% to an all-time high. So that really propelled the S&P and the NASDAQ, with Apple being one of the largest holdings there. But if you look under the surface, mid caps and small caps did not do so well. Mid caps were down about 1/3%. Small caps were down about 41 basis points, so 0.41%. And on the eve of the Fed announcement. And we know the Fed's not going to do anything tomorrow when it comes to rate changes, but what they say will move markets. Now, today rates were down a bit, and that's something to consider, kind of front-running a potential move in rates tomorrow, or move in market expectations, let's say that, tomorrow. The credit markets were fine overall. You didn't see any real issue there, any big movements. But that was an interesting development so far to see the fact that the credit markets are hanging in there, even though small caps, mid caps, those have been a bit weak. I still expect a choppy market going forward. Yes, Apple had an upgrade today, but that's not always going to be the case, right? You're going to have other catalysts, and the Fed is going to be the main one there. So that was the market today, and we'll see what the Fed has in store for us tomorrow. GameStop was up 10% or 22% today, so that's still going on, that craziness over there. Let's see, uranium was down, and yeah, that's pretty much it. Now let's pivot over and talk about our main focus points today, and that is in regards to the efficient market hypothesis. And this is really the basis for indexing. And that's why I think it's so crazy and overblown, the whole indexing craze, because it's based on a hypothesis, not proof, but a hypothesis. And this is from Eugene Fama. He is a Nobel laureate, and many consider him to be the father of modern finance. Now, there are others in the academic space that would argue that distinctly. There's the behavioral finance part of it that Eugene Fama certainly ignores. And I think it's pretty clear we're emotional beings. To be human is to be emotional. And so to say that our emotions do not impact the efficiency of the markets, I think is just disingenuous. Now, what Fama found was that price movements were hard to predict, and what he tried to do is take the data, crunch it, and come up with a hypothesis to what drives market performance. And his assertion was that markets were efficient, that all available information about publicly traded assets were priced into stocks. And so there's no edge. Now, there are different forms. One is weak form efficiency. That is basically all past data and current data about companies is reflected in the stock price, and there's no use case for technical analysis. Then there's strong form efficiency, and that's semi-strong form efficiency. And that's basically saying that all public information is priced into stocks. And that you can even use fundamental analysis, right, looking at quality of the business, etc., to make good decisions. And then there's strong form efficiency, which is saying that there's all information at all, both public and private, is integrated in the stock price. Now, 3 is pretty clear. It's not strong form. Otherwise, front-running positions and insider trading wouldn't be profitable. But we know with congressional trades, it certainly is profitable, right? We know that. Now, semi-strong, I could argue not that either. Because what we talked about today with quality investing over just straight up dividend investing or low vol investing, that is a form of superior asset allocation. And if it was semi-strong efficient, that there wouldn't be a place for quality investing because that edge would be priced out of markets. So I think at the very best, it's weak form efficient, but I don't even think it's that because I think there are pockets due to lack of focus by certain large entities. Think of small cap names that are not followed by a lot of analysts. I think for that reason, there's a lot of inefficiencies in mid and small cap, and that's why active management tends to work better in the mid and small cap space. And in general, the emotions that the average trader uses to make decisions, that also creates inefficiencies in markets. So I'm not a big fan of the efficient market hypothesis. I think it can explain some price movements, but not all. And once again, it's a hypothesis. And that's why I think the over-reliance on indexing is leading a lot of investors astray. Now we're heading into a break, so give me a call now at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
On the next InvestTalk, we will look into this warning. Be prepared for the hidden costs of home buying. According to a new report by Bankrate.com, the hidden costs of home ownership added up to an average of $18,118 annually, or $1,510 per month. So we will dig into that story tomorrow. But now let's play another caller question from 888-99-CHART.
This is Daniel in Tennessee, and I had a question for you about Ally Financial. Ticker symbol is ALLY. I recently bought a stake in them, and I noticed not long after I bought the stake that I think it was Morgan Stanley downgraded them. So I started doubting myself and was just curious to get your take on whether now was a good time to buy or if I should change my mind. Everything looked good to me and, just on the financial analysis, but just wanted to get your take on it as the experts. I'll listen for your answer on the show. Thank you.
Now, the first thing all of you out there have to understand is to not listen to the major banks' buy or sell recommendations. Do not listen to them. They don't have predictive power. Okay? In addition, they tend to all give buy ratings when the market's at an all-time high or the stock is at an all-time high. And vice versa. When things are not going well, they have a sell recommendation and everybody's out of it. That's not what analysts are good for. Buy and sell recommendations. What they're good for are earnings recommendations, earnings trends, because they're talking to the leadership in the company. They have a pulse on the industry and what is happening on the ground. Now, how does the market price in those earnings expectations, that's another story. But there are too many other factors to say whether that stock's going to go up or down. And so an analyst is only focusing on the earnings. And so that's what they're good at. They're not focusing on the macro interest rate policy that could impact the multiple that they're trading at. They're not focusing on the liquidity that the Fed or central banks globally are putting out there that are going to impact multiples on stocks, for example. They don't think about those things. And those, frankly, matter a lot as to where that stock is going, especially in the short to medium term. So only listen to analysts in so much as you're looking at the total earnings expectations from all the analysts. That's it. And then you look at the other factors and you can come up with a price target. But do not rely on that. Okay. Now for Ally, this is a company that made a ton of money in 2021, $8.22, all-time high. But earnings have steadily come down. Supposed to earn only $2.99 this year. From pre-pandemic, they were earning $3.84 in 2019. So the earnings have been kind of all over the place. 3.1% dividend yield, that's fine. Let's take a look at the profitability because as we talked about many times, it's all about its profits. And remember, this is a spin-off from GM Credit. And so they are tied into the auto market. But if you look at return on invested capital, only 2.5%. Not that high. And frankly, the momentum that we saw from the lows in October is starting to wane. And the MACD line is below zero. So I'm not a huge fan of this. I don't like the trends in earnings. I don't like the slowdown of the momentum that we saw from the fall. And I think there's just better names within this specialty finance space that you could buy. So I'm going to pass on Ally. Thanks for the call. Now let's talk a little bit about picking good stocks. Okay. And a lot of people focus on the laggards. They're looking for that great value. Now for the average investor, the odds of the average investor picking from those companies that say have relative strength of 20 or lower, meaning 80% of the stocks have underperformed it, it's down a bunch. The odds of you actually picking the name that will turn around in the short to medium term are very low. Okay. Instead, what most investors should be doing is the exact opposite, which is looking for names that are stronger. Why is that? Because weak performers tend to have weak sales, market share losses. And guess what? Funds are going to dump those companies and put extra pressure on the downside. Now, when the funds are done and you have market capitulation and the stock is plummeting to new lows, you have huge volume, that can be a sign that maybe the bottom is near. But most people are not paying attention to that. And most people don't have their antennas up to find those particular names. So the odds are better that you will pick a name that will just continue to go down and down and down. The better chance of picking a winner is to pick those names that are doing well, have done well as of late. The trend is your friend, as they say. Now, there's a fine line, though, between buying the winners and chasing performance. Now, we talk about relative strength all the time. You're looking at the performance relative to the overall market. Now, if you're going to focus on relative strength, what most people are going to do is they're going to look at those that have relative strength in the high 90s, saying what are the top 1, 2, 3% of performers in the entire market over the last year. The numbers say, though, that is a difficult game to play because a lot of those names probably are a bit extended. They're probably overvalued. But it might be signaling that, hey, there's something to pay attention to here. And that when the stock cools off a bit, not goes down 80%, but hey, cools off 15, 20, 30% from its all-time high, but still maintains a longer-term uptrend, those are the better stocks to be buying. After they've gone through a period of consolidation, working off maybe some of the excess, shaking out some of the weak hands. And so the studies show that the biggest winners are ones actually with relative strength in the 80s, right? Very solid performers, but not the best of the best. Because the best of the best, you're too late. But the ones that are still pretty good, those are the ones that don't have the froth, right? Don't have investors tripping over themselves to get in. Right? It's had a bit of near-term volatility to shake out some of those weaker names. So that's the way you utilize relative strength and you find the winners. If you see a relative strength in the 90s, those are probably names you keep on the watch list. And you say, hey, when this gets down to the mid 80s, that's when I think about buying this again. Because that's when the weak hands are shaken out. But the reason why the stock is currently at an all-time high likely is still intact. Now, you still have to do your research, make sure that's the case, but that's how you utilize charting, relative strength to find the superior names. Now, let's keep things moving and go back to the InvestTalk voice bank for a question that came in earlier from Florida.
This is Vince from Orlando. I know this question has been asked and answered before, but I could use a refresher. I have a Roth 401k through my employer, and in the event of leaving my employer, can you explain the steps of how to roll over your 401k? And I believe there was a certain verbiage you said to use that would ensure that you are not penalized when doing so. I'll listen on the show. Thanks.
It's very simple. If you have a Roth 401k, you want to open a Roth IRA. We always recommend a large brokerage firm. And if you have a traditional 401k, you want to open up a traditional IRA. Now, some people have both. They might have a 401k with a little bit of both, a little bit of Roth money, a little bit of traditional, but you're going to roll like for like, Roth to Roth, traditional to traditional. And the mechanism is simple. Like I said, you have to set up those accounts. You have to have those type of accounts somewhere. And then you're going to call your 401k provider and you're going to say, hey, I want to do a rollover. Please issue me a check. Now, some providers will send that check directly to your broker. Some will say, no, we can only send it to your address. There's an extra step. They'll send it to your address. You'll just mail it off to your broker. So we always like it. It's always cleaner when you can just mail it directly to the broker, have it made out to you or to that brokerage firm for benefit of your name, etc. Every brokerage firm is different, so they'll give you instructions on how to do that. But there is a liquidation process. They will sell all the funds within that 401k. So you'll have a week or two period where you won't be invested. So understand that. But it's relatively a simple process. And pretty much everybody should be doing this. If they have an old 401k of any type, they should be rolling that into an IRA of the similar type. Thanks for the call. Now let's play two in a row from 888-99 chart.
I'm calling because I just recently started a new job and they have ESPP program. And I just wanted to see if you guys would recommend joining the program. It is at a discount and it would be for Onto Innovations. Ticker symbol is ONTO. Let me know what you guys think about it. That'd be great. Thank you.
All right. ONTO. Onto Innovations. This is one of those names in a nice, solid uptrend. Relative strength 96. It is pretty expensive. But if you look based on forward-looking earnings, $6.43, it's a $218 stock. That's a hefty multiple. It's a mid-30s multiple. But it is a good name. For everyone out there, It's about a $10 billion market cap. They're engaged in the design, development, manufacturing, and support of high-performance control systems, detect inspection, lithography, and data analysis systems used in microelectronic devices. So they are in the semiconductor equipment space, and we know semiconductors, it's a hot place to be right now. I like the profitability. Right, the earnings continue to go up and up and up. Now, it doesn't have huge profits from a return perspective, return on invested capital, about 8%. Historically, that does tend to average around more like the low teens. So solid, not amazing. My worry is that it is just a bit expensive. I like that they don't have any debt, but it's trading at a pretty high multiple. Price sales 12 times. So, I don't know what discount you're getting. If you're getting a substantial discount, I would say 25% from here. I might do it, but I would need at least that at these prices. But it's a good company. So congratulations on the new job. And maybe when the stock gets a bit cheaper, that's when I would initiate your position. There's another question that came in via the YouTube channel. And Jim says, what are your thoughts on IMMR? IMMR. This is Immersion, develops haptic hardware and software enabling users to interact with digital devices. So small cap name, $325 million market cap. Supposed to earn $1.21 this year, but they earned $1.21 last year. Supposed to earn only $1.15 this year, down 5%, and then 87 cents next year. And that's my issue with this name is earnings all over the place. They made $2 in 2018, then they lost money in 2019. They even lost money in 2017. They're just really all over the place. Now, the technicals have broken out. It was trading and consolidating around the $7 range. Now we're up to $10 and been consolidating since. I just don't like the up and down nature of this name. This peaked in 2021 around $16 per share, then fell all the way to $4.50. To me, this is such a small name. It's $325 million market cap. You can consider this micro cap. It doesn't have a ton of volume, especially considering it's only a $10 stock. This is a trade. This is not an investment. Okay? There's just not enough track record here to make you say their business is going to boom and continue to boom, and you have a long-term buy and hold here. It's simply a trade. They're profitable right now. Return on invested capital is 25%, return on equity around 20%. That's nice profitability. But I don't like the fact that profitability waxes and wanes. It's up and down all the time. So how do you know that these earnings are going to be sustainable? Frankly, you don't. And the markets or the analysts are telling you it won't because it's supposed to have a 24% drop in earnings next year after a 5% drop in earnings this year. So I'm just going to pass on it. It is cheap, I will say that, but I rather have a more consistent earner. Thanks for the call. Now, we completed our latest wealth webinar today, and we'll be posting it online via our YouTube channel soon. So head over there and make sure you subscribe to the InvestTalk YouTube channel. And our work continues after this final break. So get your questions in now at 888-99-CHART.
Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. Together, we're here to guide you through the maze of investing and give you insights that impact your portfolio.
Whether you're a seasoned veteran or just getting started, we've got you covered. The latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and anytime on our InvestTalk listener line. Just call 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So, why join us? To get ahead in your investment journey with strategies, tips, and knowledge that can unlock the full potential of your hard-earned money.
But first, hit subscribe, turn your notifications on, and let's start making informed investment decisions together.
Welcome to InvestTalk.
Jared in North Carolina, listen to the show all the time. I wanted to get your thoughts on Energy Transfer. The ticker symbol is ET. Still an energy play. Seems like it's priced, pretty fair at these values. Just wanted to get your thoughts on a good entry point. Thank you. Love the show.
All right, looking at Energy Transfer, and in fact, this is actually one of the few stocks we talked about in the Q&A session of the webinar today. And it was really, the main question was, is this a quality name? And a lot of people are probably looking at this. It's an 8% dividend yield. And the first thing I said was, this is a limited partnership. It's an LP. So that 8% is going to be taxed at your ordinary income tax rate, which varies for every person. And you certainly don't want to own this in a tax deferred account like a 401k or an IRA or a Roth IRA, or et cetera. So that's the first caveat. So the 8% isn't as juicy as it looks. And as we talked about on the webinar as well, is you don't want to just focus on the dividend. You want to focus on the quality of the business. And the first is profitability. Return on invested capital here is 7%. Solid, but not amazing. Okay, and that is actually near its all-time high. So it's improving its profitability. That's a good thing, but it's still not amazing. We want to see that usually double digits, ideally in the mid-teens or higher. Okay, return on equity 9.5%. Once again, okay, not amazing. Also near an all-time high in profitability. And then debt. You want a balance sheet that is not overly levered. But this is a balance sheet that's overly levered. $53 billion in long-term debt on a $52 billion market cap. And that debt continues to go up and up. In fact, long-term debt is now at an all-time high for this name. And their payout, and there's a reason for this. Their payout ratio is 107%. So that's saying that it's not earning enough to pay out this dividend on a long-term sustainable basis. And if you look at the number of shares outstanding, that continues to go up as well. In 2019, they had 2.6 billion shares outstanding. Now they have 3.37 billion shares outstanding. Okay? So all this lines up to a name that, yes, looks like it has a high, nice, juicy payout, but it's not growing. In fact, earnings this year are supposed to be $1.48. It was $1.89 in 2021. So the earnings picture remains relatively flat. And a key tell about a dividend payer, whether that dividend is sustainable or not, is, are they raising their dividend? And the simple answer is no, it's been flat since 2019. In fact, they eliminated their dividend, they didn't eliminate it. They dropped it from 30 cents a share all the way to 15 cents a share. They cut it in half in 2021 for good reason, right? You had COVID and there's a lot of uncertainty, et cetera. But it just shows you the level of debt that they have and, the low profitability that, in tough times, that dividend is going to go away. As we talked about in the webinar, dividends are not sacrosanct. They can be cut and will be cut at any given time. So I just think there are better names out there. I generally like the type of business. It's a pipeline business. They move, they collect a toll by helping move natural gas, crude oil, natural gas liquids from place to place. Now we own a name in the same space for clients. We have for a long time. So it's not like we don't like the business, but we want something with lower debt. We want something that's paying qualified dividends, that's not a limited partnership, so that our clients are not taxed at their ordinary income tax rate for those that have taxable accounts. And then we want much better profitability. And you certainly can find that elsewhere. And the debt part is even more important in today's market. Why? Because interest rates are headed higher. And so many of these names, especially in the energy transfer business, that's the name of this company, they have high capital costs. And those costs are going up. So wanted to highlight that, and thanks for the call on energy transfer. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And of course, head over to our YouTube channel. Just search InvestTalk over there. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.